Local institutional investors have become significant players in Nigeria's stock market, but how are they likely to invest in the second quarter? I'm joined in the studio by Victor Inyang, he's the Chief Investment Officer at Mansard Investments. He has over 20 billion naira in under management. Thank you so much, Victor, for joining us. And like I did mention, it seems right now we're getting a lot more institutional investors involved in this market. But the key question is, how do we go forward from here? But maybe before we go into that, a quick review of Q1 and how you invested compared to where you were in Q4, particularly in equities.
Sure. Well, probably the best way for me to even start is to review how our view of the macro situation. When I was on your show last, about 6 months ago, I was an avowed bull, and we had started investing from then, particularly in Q4. Now, I think our asset prices, given the rally that we've seen, our asset prices are something at something of an inflection point.
Right.
From a macro perspective, our reserves are over $49 billion. That's something very good. The trajectory of an increase in our reserves is still in place. Yeah. Inflation sitting at 9.5% in February, 9% in January. Mm-hmm. That's also something very good, single digits. Oil prices, $112 per barrel on Bonny Light, and that's also very good. GDP sitting at 6.58 for 2012. I think of the mint countries, which we're now part of, we are the fastest growing.
So quite a few positives there.
Quite a few positives.
But there are certainly some negatives. I mean, one obviously will be things like the oil production.
Absolutely. Oil production, levels of oil. Our budget is set at one particular level, and I don't really see us even on actuals meeting some of those production levels. Oil thefts is a big problem. Yeah. There are also other problems. Whilst our inflation rates at the moment are sitting at about 9.5%, I think on average, the expectations are that we should be really ticking up towards the 10% level. And that has implications in the bond and also in the T-bills market and money markets as well. And also, I guess...
But overall, Q1, you were probably less aggressive for equities than Q4. I get that sense.
Yes, in a sense, because you've already been positioned, okay? And so it's really a case of watching. And then now the question is, how much more sustainable is the rally?
So that's the big question. Q2, absolutely. How are you investing now? Particularly when you look at where fixed income yields are, they've come down quite a bit.
Sure.
The market has rallied quite a bit as well in Q1, up about 20%. Mm-hmm. So the big question is, how do you invest from here? Things have started pretty well. If you look at the first 2 days of the quarter, particularly for equities, up about 3.5%. But the big question is, what next?
Absolutely. That is the key thing. I mean, we all have the expectation that 2012 is going to be one of the best years ever for the banks. But going forward, expectations are that 2013 will not match 2012. So the question now is it already priced in as far as the bank prices are now? And the earning results so far have been more or less in line with expectations. Of course, something like the higher dividend payout that Zenith gave, or dividend declaration that Zenith gave of 1.60 kobo, was very good and gave the market an extra spurt. Yeah. But all in all, there are a number of things facing the banking sector in particular. Consumer goods have already rallied quite strongly. There are some sectors, let's say the building materials sector, that has really been somewhat neglected, that could see sector rotation going into them. Yeah. That's good. But all in all, the questions really have to... today, or as of yesterday, we were 23.04, something like that, % up on a year-to-date basis on the equity market. Expectations were for 25 to 30% by year end. So is it that we're going to overshoot that mark, or is it that we're going to go higher now and see a correction later? These are all factors that we need to start considering.
Okay. I wanted to get your thoughts on fixed income, but I want to zero in on banks right now. It's a key sector if you're investing in equities. Quite a few risks when you look at their pressure from some of the changes we're seeing in terms of regulation of bank charges.
Absolutely.
Plan to phase out cash commissions on transactions by 2016. Mm-hmm. I think it should be a key concern for investors, but what are your thoughts about that and the risks for earnings going forward?
I totally feel the same. I mean, in the first instance, yields on the easy parts of banks' income, i.e., placing funds in the treasury market and the like, those yields are substantially lower in 2013 than they were in 2012. So
No
that's one
easy
problem
money
there.
from fixed
No
income.
easy money from them. Okay, so now what are they going to have to do? They're going to have to go out and lend more. Okay, but in lending more, AMCON, well, number one, the AMCON levy is higher going forward. And then, of course, AMCON is no longer going to take any bad loans from the banks.
So they need to be cautious.
So they need to be cautious. So they're almost caught between a rock and a hard place. Yes, they have to go out and lend more, extend credits more, but really are credible borrowers, as the pool of credible borrowers within the economy increased. A lot of people were looking to the power sector to create that, and I know that some banks are already dispersing towards power projects. But that, to me, is still something in terms of returns. That's still something of a more medium-term, medium-term play. And so for me, 2013, I would be surprised, given the level of returns we've seen the banks churning out this year, last year, 2012, I would really be surprised to see if any bank can really match in 2013 what it did in 2012.
I've really run over on time for this interview, but last point will be, how do you allocate to the banks now? Are you underweighting and overweighting? Are you just...
we are cautious. You have some part of the portfolio which is in long-term holdings, okay, so you hold those ones, but then another part of the portfolio which is more of a trading, you're looking to be more nimble and, getting out at any sign of trouble.